Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, where has the first half of this year gone? We've had 6 months of 2021, so it's a pretty good time to reflect upon what's been going on in investment markets. Now, if you look at the trends that we've seen in markets since the beginning of the year, one of the words that would stand out and probably best describe what we've seen is the word rotation. Now, at the end of February, the bond yield, so the 10-year US Treasury yield in particular, if you go and look at that on the chart, started to explode higher. And as a result of that, we started to see people jump out of bonds. They started to price in a spike in inflation. And then we saw that reflation trade really kick in, which meant that we started to see value stocks start to outperform growth stocks. That meant things like financials and cyclicals were doing much, much better than things like technology stocks. It's a trend that we've not really seen for quite a long time, to be honest. In the pandemic, in the aftermath of the pandemic, you will recall that growth stocks actually outperformed value stocks, which, if you think about it, that's technology stocks. All of those things that we were using, those things like Zoom, etc., did really well in the pandemic and when we were in lockdown. As soon as there was a vaccine and the unlocking of economies started to become a thing, then it meant that anything that was exposed to the cyclical nature of economy started to do very well. It meant that by mid-May, growth was down 2.5% up to that point year to date versus a plus 10% for value stocks, which is a significant difference. But since that point, the narrative has changed. So we started to get this idea that the US Federal Reserve in particular started to try and give a narrative that inflation was transitory. And since mid-May, we've seen the reflation trade start to stutter and unwind to a certain extent. And in fact, growth stocks are up about 11% since mid-May, which is a huge rebound. It's actually the almost parabolic, the rally in growth stocks generally, if you look at them globally, versus if you take a global index of value stocks, they're only up about 3.2%, which is still good. Of course, this does pose one potential problem for the market because it's pricing in, it's doubling down on this idea that inflation is going to be transitory. So if it isn't, then we could see another rapid repricing of assets. That includes equities and bonds. That could be the reverse of what we've seen in the last few weeks. If we look at some of the year-to-date numbers on equity markets, now, interestingly, European equity markets have kept pace with the US counterparts, so things like the S&P 500. If you take a broad measure of European stocks, something like the Euro Stocks Index, then it's up about 14%, as is the S&P 500, which goes to show the rebound we've seen since the depths of the pandemic when European stocks lagged. Don't forget that European indices tend to have some more exposure to things like energy stocks and some of the cyclical stocks that performed badly during the lockdown, but have since rebounded as economies have started to open up again. If we look more widely across the world, if you look at the all world indices, it's up about 12.5% year to date. The FTSE 100 has lagged slightly, up 9.7%. Emerging markets is up around about 7%, Asian equities 6%, and Japanese equities up around about 5%. So you can see there's a broad rally in equity markets that's occurred during the first part of this year. And of course, yes, there's been these rotations back and forth, but if we take a big picture look at it, then equity markets have been pushing higher and to new all-time highs in many cases, particularly in the US and including in Germany, for example. Then if you look at the VIX, which is the fear index in markets, that's dropped from 27 to 16.79 across the last 6 months. Again, that just shows the fear evaporating in equity markets. We've seen the 10-year US Treasury yield rally from 0.9% to 1.45%. That just, again, is another indicator that people are quite happy taking on risks, so they're moving out of bonds. Yes, it's all part of that reflation trade and the idea that inflation could be around the corner, and inflation has been picking up in the economic indicators that have been announced officially, but it also is this underlying trend of markets taking on more investment risk. The bull market we've seen since the lows back on the 23rd of March last year, once central banks entered the market and started pumping liquidity, QE into the markets and keeping interest rates low and cutting interest rates, that has propelled markets higher. And we're now entered the second year of this bull market since that low last year, which is interesting because markets are looking now quite frothy and they are looking quite greedy. But does that mean we're going to get a pullback? Because after all, it really depends upon whether central banks keep the monetary stimulus coming. At the moment, they say they are going to, but markets are starting to look a little bit nervous. We've seen some weakness in the last few days, but nothing too severe. It's just markets aren't pushing higher. They're needing another catalyst, and a lot of that is coming from the narratives that we're seeing from central banks. But if you look at the greed and fear index, CNN do a greed and fear index, and if you look at it, it takes into account a whole number of indicators to try and see if the underlying emotion driving markets is greed. So therefore, potentially a sign that we could face some kind of pullback because the market's getting carried away, or fear. And at the moment, fear is the overriding emotion in equity markets. And that's because we've started to see stocks slightly underperform bonds in recent weeks, but also because stock market breadth has been fairly starting to weaken slightly on a number of indices. So that's where, if you look at the number of stocks that are making new highs or new lows, it's starting to favor the idea that there are more and more stocks making new lows. That hasn't run away with itself yet, but it's something to watch. So at the moment, we're at a stage that from the lows of last year, the central bank liquidity has pushed the market into an incredible bull market run around the world. What the message is that this bull run has broadened out. It's not just now value stocks or just growth stocks. It's pretty much anything that's equity based that is pushing higher. We are seeing new all-time highs, but we're at a stage now when we're in the second year that you do tend to see, if you believe history, some kind of pullback. And I will do a bit more on this for 80/20 investor members on their monthly newsletter, which they will get on Saturday. So it's something to keep an eye on. First 6 months of this year have been very good for equity investors and those who've taken on risk. Let's just hope that we see something similar in the second half of this year, but history suggests that it will probably be a bumpy ride. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. You can contact me via Twitter, Money to the Masses with a number 2. And of course, we are on Instagram and Facebook. And don't forget to subscribe to our YouTube channel.